Have you ever felt like the market is out to get you? You place a trade, set your stop loss, and just when you think you're safe, the market takes you out, only to reverse in your direction? What if I told you this isn't bad luck, it's institutional manipulation at play? In this video, I'm going to reveal 3 powerful swing trading strategies that expose how smart money operates, and more importantly, how you can trade alongside them instead of being their target. We'll cover institutional funding candles, order blocks, and RSI divergence, 3 essential concepts that will change the way you see price action. So, stay locked in because by the end of this video, you'll have a trading edge that most retail traders never even see coming. An institutional funding candle is the last opposing candle before the market makes a strong directional move. In a bullish move, it's the last big red candle before price explodes upward. In a bearish move, it's the last big green candle before price plummets downward. Think of it as the market's final trick before revealing its true direction. But here's the key. These candles are not random. They are carefully engineered by big financial institutions, hedge funds, and banks to do one thing: absorb liquidity. And that's exactly why traders also call them banger candles, because after they form, the market usually makes an explosive move. To understand institutional funding candles, you first need to understand how the market really works. The market is a zero-sum game. For someone to buy, there needs to be a seller. For someone to sell, there needs to be a buyer. So when institutions who trade with millions or even billions of dollars want to enter a big trade, they need a lot of people on the opposite side. And who do they target? Retail traders. That's where institutional funding candles come into play. Let's say smart money wants to buy at a discount. They know retail traders have stop-loss orders sitting below support levels. They know breakout traders will also enter sell positions when support breaks. So what do? They create an institutional funding candle, a strong bearish candle that breaks through support, triggering stop losses and trapping breakout sellers. Once enough liquidity has been absorbed, price reverses sharply and the real bullish move begins. The same thing happens in reverse for a sell-off. Institutions push price above resistance to trigger buy orders. Then they sell from the top, causing price to collapse. This is why institutional funding candles often appear near key levels like support, resistance, equal highs and lows, trendline breakouts, and liquidity zones. They are the market's way of cleaning out weak hands before the real move begins. Now that you understand how smart money uses institutional funding candles to manipulate liquidity, let's break down how you can trade them effectively. There are 2 prime market phases where IFCs provide some of the best trade setups. Accumulation phase. A range forms after a downtrend as smart money builds long positions. Distribution phase. A range forms after an uptrend as smart money offloads their positions before driving price lower. In both cases, institutional funding candles expose institutional activity and give you a clear opportunity to trade with the big players, not against them. Look at this chart example. As you can see, the market is moving downwards, indicating strong selling pressure. However, notice how the momentum starts to slow down, and instead of continuing lower, the price begins to move sideways. This is the accumulation phase, a range where institutions absorb selling pressure before pushing price higher. Now here's what typically happens next. Price breaks below the range low, triggering stop losses from early buyers and trapping breakout sellers. Instead of continuing down, price quickly reverses back inside the range, and this is where the institutional funding candle forms. At this moment, retail traders who sold the breakout are trapped, while institutions have filled their long positions using the liquidity from those stop losses. Now, how to trade this setup? Identify the accumulation range. Look for a sideways market after a downtrend where price moves between a support and resistance zone. Watch for the false breakdown. Price should dip below support, take out liquidity, and then recover back inside the range. Spot the IFC. The last bearish candle that breaks support before price reverses is your institutional funding candle. Once price closes back inside the range, this confirms a liquidity grab. The candle that closed inside the range is your entry. You can enter at the close of this candle. Set your stop loss below the low of the IFC to protect your trade. Target the next major level. As we know, after a liquidity grab during the accumulation phase, the market is likely to break out of the range and move upward. Now let's look at what happened next. As you can see, price moves in the intended direction, hitting the target perfectly. Now, look at another example. Here the market is in a distribution phase. In this phase, institutions are not buying anymore. Instead, they're selling off their positions to late buyers, keeping price inside a range before the next drop. Here's how they trap traders. Price breaks above the range high, convincing breakout traders to go long, but instead of continuing higher, the price sharply reverses back inside the range. This is where the institutional funding candle forms. What I mean by this is that when the market closes inside the range, we can then identify the funding candle responsible for the liquidity grab. At this moment, breakout traders who bought the move are trapped, and institutions are now selling heavily into that liquidity before price moves lower. To trade this setup, you follow these steps. Identify the distribution range. Look for a sideways market after an uptrend, where price is bouncing between a resistance and support zone. Watch for the false breakout above resistance. Price should break above the range high, take out liquidity, and then reverse back inside. Spot the IFC. The last bullish candle that breaks resistance before price reverses is your institutional funding candle. Enter at the close of the candle that closes inside the range. Place your stop loss above the high of the IFC to stay protected. Target the major support level. After the liquidity sweep in the distribution phase, the market is likely to break through support and reach key levels. Now, look at what happens next. As you can see, the price drops right to our target. Important note: to trade the institutional funding candle effectively, we use top-down analysis to confirm that our trade setup aligns with the higher time frame. You spot the institutional funding candle on your trading time frame, and then you check the higher time frame to confirm the overall market direction. If you trade on the hourly, check the daily time frame. If you trade on the 4 hours time frame, check the weekly. If you trade on the daily, check the monthly. Okay, now let's move to the second strategy, which is the block order. Order blocks are pivotal zones on price charts where significant institutional buy or sell orders have been executed. When the price revisits an order block, there's a heightened likelihood of a similar reaction, presenting potential trading opportunities. However, it's essential to distinguish between general supply and demand zones and authentic order blocks. Not every area where price has reacted qualifies as an order block. Recognizing this distinction is vital to refine trading strategies and avoid common mistakes. For an area to be considered a valid order block, it should meet specific criteria, enhancing its reliability for future trades. A valid order block often forms after a strong, one-sided price movement that creates an imbalance, where price moves aggressively in one direction, leaving behind inefficient price action. This occurs due to large institutional orders driving the market, resulting in liquidity gaps or unfilled areas on the chart. These imbalances act as magnets, as the market tends to revisit them to fill orders and restore equilibrium. Order blocks play a key role in liquidity accumulation. This happens when the market manipulates price to trigger stop losses and pending orders placed by retail traders. Institutions exploit these liquidity pools to fill their positions before driving price in the opposite direction. In bullish setups, liquidity is collected below support, where stop losses of buyers and sell orders from breakout traders are located. In bearish setups, liquidity is gathered above resistance, where stop losses of sellers and buy orders from breakout traders accumulate. Once institutions absorb this liquidity, price often moves aggressively in the intended direction, with the origin of this move marking the order block. The most crucial confirmation of a valid order block is its role in breaking market structure. This is what separates a typical supply or demand zone from a true order block. In a bullish market, when price breaks above a key high, the origin of this upward move becomes a bullish order block, a strong demand zone where institutions likely accumulated buy orders. In a bearish market, when price breaks below a key low, the supply area that initiated the drop becomes a bearish order block, signaling institutional selling pressure. A break in market structure confirms institutional involvement, reinforcing the order block's importance for future price action. By applying these criteria, you can identify high-probability order blocks, align your trades with smart money movements, and improve your overall trade execution. Now, let's break down a real chart example to show how a bullish order block forms and how you can trade it effectively. In this case, the market was in a clear downtrend, consistently forming lower highs and lower lows, confirming bearish momentum. However, as price reached a key support level, we saw a sharp reversal, which laid the foundation for our bullish order block. At a significant low, the market reversed aggressively, pushing above a prior lower high. This break in market structure is a critical clue. It's a sign that institutional players have entered the market, shifting momentum from bearish to bullish. Once the market structure shifts, you need to trace back to the origin of the rally. The bullish order block is the point where smart money accumulated long positions before driving price upward. This is typically a strong bullish candle at the end of the downtrend. A strong bullish move often leaves behind an imbalance, a price gap where orders were left unfilled due to rapid movement. These fair value gaps are important because they hint at institutional activity, and more often than not, the market will come back to fill that imbalance. After the initial bullish impulse, price retraces back to the order block. This is where we wait for signs of confirmation. As price enters the demand zone, we observe how the market reacts to this level. As price retests the order block, we look for confirmation signals such as rejection wicks showing buying pressure, bullish candlestick patterns like engulfing candles, a minor structure shift indicating renewed buying interest. Once price shows confirmation and starts moving upward, this is the entry trigger for a long trade, aligning with institutional buying momentum. Now, let's examine a bearish order block which follows the same principles, just in the opposite direction. In this case, the market was in a strong uptrend, forming higher highs and higher lows. However, upon reaching a significant resistance level, price struggled to push higher, eventually reversing sharply and breaking the previous higher low, signaling a bearish shift. When price fails to continue higher and instead breaks below a recent higher low, it confirms a bearish market structure shift. This indicates that smart money has begun shorting the market. The starting point of this strong downward move is the bearish order block. This is usually a large bearish candle before price drops sharply, marking the area where institutions likely entered short positions. As price falls rapidly, it often leaves behind fair value gaps, areas of inefficiency that indicate strong institutional activity. The market will often return to this zone before continuing downward. After the initial sell-off, price retraces back toward the bearish order block. This is where you watch for the supply zone to be tested, looking for a possible short opportunity. When price re-enters the bearish order block, watch for 3 key signals: rejection wicks, which indicate selling pressure, bearish candlestick patterns like engulfing formations, and a short-term structure shift, confirming continued bearish momentum. When all these signals align, it's your confirmation to enter a sell trade with the expectation that price will continue moving lower as the bearish trend resumes. As I always say, top-down analysis is crucial. This is the trade plan, but you still need to analyze the higher time frames to make sure your setup aligns with the overall market direction. Trading against the higher time frame trend lowers your chances of success, so always confirm the bias before you execute your trade. Now, let's move on to the third strategy, which is the RSI divergence strategy. RSI divergence is a powerful technical analysis tool that helps you identify potential market reversals by comparing price movements with the relative strength index. RSI divergence happens when price and the RSI move in opposite directions. This signals that the current trend might be losing strength and a reversal could be coming. For example, if price keeps rising but the RSI starts to fall, it often means the uptrend is weakening. Similarly, if the price is falling but the RSI begins to rise, it may indicate that the downtrend is losing strength. You can use 2 main types of RSI divergence to analyze potential market movements: bullish and bearish divergence. A bullish divergence occurs when price makes lower lows while the RSI forms higher lows. This usually happens when the RSI is below 30, a level that indicates the asset is oversold. Even though price keeps falling, the RSI suggests that selling pressure is weakening. This could be a sign that a bullish reversal is on the way. Bullish divergences are often strong signals that the trend may soon shift to the upside. In a bearish divergence, the price forms higher highs while the RSI makes lower highs, often around 70 or above, signaling that the asset is overbought. Although the price continues to climb, the RSI indicates that buying pressure is weakening. This is usually a sign that the uptrend is losing momentum, increasing the likelihood of a downward reversal. Now, let's apply this strategy to identify high-probability trade setups. In this example, the market is in an uptrend, forming a higher high while the RSI prints a lower high, indicating divergence. However, divergence alone is not enough to confirm a trade. We need additional confluence factors to strengthen our entry decision. As you can see, the market broke above this resistance level, yet we still have divergence, which signals a potential reversal. This means we need further confirmation before taking a trade. Now, look at what happened next. The market initially broke above the resistance, but then closed back below it, creating a clear liquidity sweep. This liquidity grab validates the divergence, providing an additional confluence factor to confirm the reversal. Before entering the trade, it's essential to check the higher time frame to ensure it aligns with the trading time frame. If the higher time frame is in a downtrend or showing signs of weakness, you can place a sell order at the close of the candle that closed below the resistance level. Set your stop loss above this candle and target the next key level. As expected, the market moved toward the target. Look at another example. As you can see, the market is trending downward while the RSI is in the overbought zone. The market makes a lower move while the RSI moves higher, indicating another clear divergence. Now, we have another confluence factor that strengthens our entry decision: a liquidity sweep. Here, the market triggers stop-loss orders placed by buyers, creating a false breakout before closing back above the level. This confirms a liquidity sweep, further validating our trade setup. At this stage, we have both RSI divergence and a liquidity sweep. The next step is to check if the higher time frame aligns with the setup. If you want a deeper understanding of top-down analysis, be sure to watch our dedicated video on the topic. Once all conditions are met, you enter the trade at the close of this candle, set a stop loss below the liquidity sweep, and aim for the next key level. As you can see, the market moved to the target as expected. Now you understand how smart money moves, so start using these strategies to trade with them, not against them.